Welcome to Geojit Spotlight. Last week, we asked our viewers to share their share market investment related doubts through our social media handles. Not surprisingly, we received a lot of questions. We have summarized some of the top questions across categories, and Geojit Chief Investment Strategist Dr.V.K Vijayakumar is addressing the key concerns that our viewers have expressed. Welcome, sir.
Thank you.
So the market is setting new records. How far can this rally go, and what is the near-term outlook?
Yes, the market is setting new records. This year, Nifty and Sensex has set many all-time highs. The hallmark of a bull market is its ability to set newer and newer record highs. This is happening in India now. This is happening in the mother market, US also. S&P 500 has been setting record highs. Similarly, NASDAQ also. So this market construct is very favorable. Therefore, we can say that the undertone of the market is very bullish, and this bullishness is likely to continue also. But then investors have to be a little bit concerned because of the rich valuations in the market. One has to concede that the rally has fundamental support also. As I said, the support from the mother market US and the global economy is there. And in India, economic growth is much better than what was expected 1 year back. And for the next year also, economic growth rate is projected at around 7%. That is the latest from the RBI. And the inflation is expected to come under control. Already, the core inflation in India is only 3.3%. All these are very positive. But then the concern is about valuations. Therefore, if the market continues to be very bullish and continues to set newer and newer records, we will be slipping into overvalued territory. Because one of the factors which is driving the market now is the liquidity. Massive liquidity flows. The total demat accounts, which was around 4 crores in 2020 early, is now more than 15 crores. The monthly SIPs have crossed 19,000 crores. And the retail investors and HNIs are very optimistically investing in the market. In such a scenario, the market will continue to be resilient, continue to be strong. But investors have to be a little bit concerned about the valuations. At record highs, it is always a good option to partially book profits and also to move some money to fixed income investments.
Election outcomes have always impacted the market. If the BJP or NDA loses power in the elections, what will be the impact on the market?
Well, we discussed this in detail in our previous discussion. Well, the market has now discounted for the past, let us say, for 4 months now. The market has been continuously discounting the BJP, NDA to retain power in the coming elections. The reason why I say this is, on December 18th, when the market opened after the election results to the 4 assembly elections were declared, the Sensex shot up by 1,387 points. Right? So more than 2% appreciation in one day. Market had started discounting that the present dispensation will continue in power after the elections also. So that is what the market, and after that, this discounting of the present ruling dispensation is continuing. So this is what the market has already discounted. As I explained in our previous discussion, the market does not have any preference for a particular political party. The market likes stability. So if the present dispensation comes back to power, there is stability. If it does not happen, then there is a lot of instability. We don't know who the Prime Minister will be. We don't know whether there will be changes in economic policy. And uncertainty is what the market does not like. So that is why the market has already discounted that. And therefore, if the election results go against what the market has been discounting for a few months now, there can be a sharp correction in the market, there can be a crash in the market, there is no doubt about that. But the probability of such an eventuality is very, very low. I would say less than 5%.
So you have been warning about the excessive valuation in the broader market, particularly the small cap segment. After the concern expressed by SEBI, the small caps corrected, but have bounced back strongly. What is your view now?
Well, normally in a normal market, large caps will have higher valuation than mid caps, and mid caps normally will have higher valuation than small caps. The reason is large caps are safer than mid caps, mid caps are safer than small caps. When there is a sharp correction in the markets, there will be disproportionate correction in the broader market, mid and small caps. So the risk is very high, particularly in the short term, in the mid and small cap segment. So that is why the SEBI chief warned about this high valuations in the broader market, particularly in the small cap segments. She said in that warning that the valuations in some segments are frothy valuations. That is a warning, right? And already there were signals from the market itself that valuations in these segments are elevated, excessive, and difficult to justify, because many mutual funds in their small cap schemes had stopped accepting lump sum investments. Some 4 mutual funds said, we will take only SIPs in our mutual funds. So this was the mutual funds themselves sending signals to investors that the valuations are excessive. So that is why the SEBI chief also made this warning. So when this warning was given, then the markets corrected, particularly the small caps. There was a sharp correction, but after that, market again started moving up. Last week, small caps bounced back by 7%. So this is the kind of liquidity that is the most important driver of this rally in small caps. Last year, 64,000 crores, I'm talking about calendar year 2023, 64,000 crores were invested in these segments. Because the retail investors, vast majority of retail investors, very much impressed by the performance of the broader market in recent years, are chasing these mid and small caps. Therefore, we still have our concern regarding that. We also would like to reiterate that at this present juncture of the market, when the Nifty is close to, let's say, 23,000 now, investors should give a priority to safety, and safety certainly is in large caps. Therefore, priority should be to large caps, not small caps. Mid caps are not as excessively valued as large caps. There are many quality stocks in mid caps.
In January this year, you had recommended investing in auto sector. It has done well, and are you still bullish on autos? Any other preferred sector?
In our first discussion in 2024, our top sectoral pick was automobiles. The reason why we suggested automobiles was, automobiles is a segment, it's an industry which will go through cyclical ups and downs. So it has been in a cyclical downturn for some time, and now we are witnessing a cyclical upturn. If you look at the monthly sales figures from the leading companies like Maruti or Tata Motors or Bajaj Auto, M&M, Eicher Motors, all these companies are coming out with very impressive sales figures and profit figures. So this industry is on a cyclical uptrend, and that is why it has done exceedingly well. It has done better than our expectations during the last 3 months. We expect this outperformance to continue. But if you ask me, is there a new sector that we prefer now, say in April, this was done, this sectoral pick was suggested in January, and now we are in April. In April, I would say that financials now in the near to short term, not short term, even to in the mid to long term also, financials, particularly large cap banks, offer a very attractive investment opportunity. I have said before that the valuations in the market are high. Nifty is presently trading at around 20 times FI25 expected earnings. For FI25, Nifty EPS of Nifty 50 companies is estimated to be around 1,140, that range. So presently Nifty is trading at 20 times FI25 earnings. This is much higher than our long-term averages. Partly this is justified because India has the best growth story and our corporate earnings potential also is very high. That is why investors have confidence to invest even in this high valuations. But even in this elevated valuation scenario, financials, particularly large cap banks, are attractively valued. They are not excessively valued. Stocks like HDFC Bank, ICICI Bank, in public sector, State Bank of India, these are even now attractively valued. I would say, if you take into consideration the price to book multiple and the price earning multiple, these are attractively valued. Moreover, the coming the results season will start on the 12th of April. I expect the results of private sector banks. Public sector banks also will do well in terms of results, but private sector bank results is likely to be better, and their stock market performance also is likely to be better. The reason why I say this is a likely scenario in the second half of this calendar year, 2024, is a big spurt in foreign institutional investment, because it is a highly probable scenario that the American Central Bank Fed will cut interest rates twice or thrice in the rest of this year, 2024. They have not cut so far, but minimum 3 rate cuts are possible. And when that happens, US bond yield will decline and foreign portfolio investors also will start investing. Now we have a scenario where DIIs are investing heavily because there is huge fund flow. But along with this DII investment, retail investment, HNI investment, if FII investment also starts picking up, FIIs will be investing in their preferred stocks like HDFC Bank, ICICI Bank, and such other large cap financials, because they may not have performed very well. For example, HDFC Bank, last 1 year, 2 year performance has not been good. But if you look at their last 5 year, 10 year, 15 year, 20 year performance, that is one of the best in the world. Therefore, if the FIIs also start investing, then you will see substantial appreciation. This will not happen in 1 month or 2 months' time. One problem I find with our investors is, say, I make a suggestion like HDFC Bank is good. Then one person who watches that video makes a comment. After you said the stock has come down by 3%. So it has happened in 1 week. I am not saying that the share will go up in 1 week or 1 month or 2 months. Minimum time horizon you need 2 years, right? Therefore, those who have a time horizon of 2 years or more can certainly look at these marquee names in large cap banks. Automobiles will continue to do well. Capital goods, that was one suggestion that we gave in 2023 early. You must be remembering that. Particularly mentioned stocks like Larsen & Toubro, ASEA Brown Boveri, Siemens and Cummins. All these 4 stocks have done exceedingly well. These are large cap stocks. Now, another segment which can be a dark horse and that will start responding after the Q2 results. The IT results from TCS, Infosys, HCL Tech, results will not be good. Market already knows that, because the guidance from Accenture has been very tepid guidance. So the guidance will be poor. can be poor, but if the management commentary has some optimistic overtones, that is likely, right? If there are some optimistic commentary from the management, then this segment, IT companies, will bounce back because all the bad news is already in the price. So if the commentary is good, that will offer a contrarian buying opportunity because the valuations are not excessive.
So another question is on SWP. How good is this? Will it always work? Any risks?
Well, we had explained about systematic transfer plans and systematic withdrawal plans in one video. I did one video only on STPs and SWPs. So everyone knows what systematic investment plan SIP is. Systematic withdrawal plan is a plan where you can withdraw a particular amount of money from your investment periodically, say every month. This is ideal for people who invest, people who expect a periodic regular income. Now, systematic withdrawal plan can be planned in two ways. If you had made, for instance, if you had made a lump sum investment in an equity fund or a hybrid fund some 5 years back, your investment would have appreciated substantially. Then for the next, let us say a few years, you can withdraw a particular amount of money every month, right? The advantage of that systematic withdrawal plan is that, for example, let me exemplify that. If you withdraw 8,000 rupees every month, that means in 1 year you will be withdrawing 96,000 rupees, so less than 1 lakh. Now it is important to understand that long-term capital gains up to 1 lakh is exempt from long-term capital gains tax. So on this 96,000 rupees that you will be withdrawing in 1 year, you will not be paying any tax at all. At the same time, you will be assured of a regular income. That is the advantage of this SWP. The other plan for SWP is to make a lump sum investment now and wait for a particular period of time, let us say 2 years or so. And after 2 years, if you have a good appreciation in your investment, then you can start systematic withdrawals every month, right? But then one risk in this investment is, suppose you are choosing the second option of investing now, waiting for 2 years and opting for a systematic withdrawal plan. It is possible that in the next 2 years, your investment may not give you the kind of returns that you expected. In that case, systematic withdrawal plan will not work, particularly the taxation part, will not work as effectively as in the earlier strategy where you invest a lump sum amount 5 years back and you are using that money for systematic withdrawals.
Another question is on small finance banks, particularly on the prospects on ISAF Bank.
Well, within the banking segment, one sub-segment which is doing very well is the small finance bank. Small finance banks are a reasoned category, and a very important characteristic in the trend from the small finance banks is that they are recording a credit growth much better than the credit growth of traditional banks, large banks, right? And that is why their results also has been good. If you look at the credit growth, their profitability growth, that has been good. And it is getting reflected in the stock prices also. Now, my response to this particular specific question on ISAF Bank is ISAF Bank, actually it had a great response to the IPO, but recently the stock price went very, very low, went much below the issue price. That was a little bit of a surprise. One concern, actually the concern that was getting reflected in the market was the worse than expected gross non-performing assets of ISAF Bank. Their main business is from Kerala, and in Kerala, the gross non-performing assets and also the net non-performing assets has been high during the last few months or so. But I think this is a a recent, and this is only a temporary phenomenon. The bank is a solid bank, excellent management. Credit growth is impressive, very professionally managed. And the advantage of small finance banks like ZAMP is their very impressive net interest margin. Net interest margin is very good. Therefore, if you have a high net interest margin, and if you are successful in raising deposits, and if you can successfully maintain the credit growth, there can be very good profitability going forward. So the present headwind is only a temporary headwind. This is my view. The medium to long-term prospects of the bank are certainly very bright.
Thank you, sir. Thank you very much.